the $13.5 billion illusion, why America's record-breaking Cyber Monday is a sign of economic collapse. Yesterday, the financial headline screamed, Cyber Monday shatters records with $13.5 billion in online sales. The message was clear. America's economy is roaring back, consumer confidence is unshakable, and the recession fears of the past few years have vanished. The holiday shopping season, they declared, is proof that prosperity is here to stay. But if you believe that story, this analysis will shatter your illusions. As someone who's been watching this market for years, I'm here to tell you, this is not a sign of strength. It's a mirage, a dangerous illusion built on inflation, debt, and statistical sleight of hand. That $13.5 billion isn't wealth being created. It's the future being mortgaged. And beneath the glitter of record sales lies a terrifying truth. The U economy is quietly experiencing a credit implosion. This isn't prosperity. It's the largest suicide spending event in modern history. Let's cut through the noise. No emotions, just data. I'll take you deep into the shadow debt markets the Fed won't talk about and show you the ticking time bomb set to detonate in Q1 2026. The math that burst the bubble. Media outlets proudly report a 9% year-over-year increase in holiday sales. Sounds impressive, right? But that's nominal growth, the raw dollar amount. As investors, if you're still looking at nominal figures, you're being played. We need to look at real purchasing power. Let's rewind. From the massive stimulus of 2021 to today, cumulative inflation in the US has officially hit just over 20%. But if you've shopped at Walmart, filled up your gas tank, or paid rent and insurance lately, you know the real cost of living has surged 30% to 35% or more. So what does that mean? Americans are spending 9% more this year, but they're actually buying fewer goods than last year. This isn't upgrading their lifestyles, it's inflation-induced desperation. And here's the kicker. Much of that $13.5 billion comes from artificial price games. Retailers have been quietly hiking prices for 3 years by as much as 40% on some items. Then, during Black Friday, they offer deep discounts that look generous but are actually just a return to pre-inflation levels. A sweater that cost $50 in 2021 is now $80, then discounted to $56. Consumers feel like they're getting a deal. In reality, they're paying more than before while profit margins shrink. This record isn't about wealth, it's about currency devaluation. It's a bubble of inflation, masking a brutal truth. American consumers' real purchasing power is collapsing. The hidden debt crisis, BNPL, and the ghost loans. But inflation alone isn't the real threat. What keeps me up at night is how people are paying. In traditional economic models, we monitor risk through bank credit data. But in 2025, the danger has moved to a regulatory blind spot. Buy now, pay later. According to Adobe Analytics, BNPL orders surged 18% in just 1 week during Cyber Monday. Why is this so dangerous? First, BNPL is ghost debt. When you use a credit card, the debt shows up immediately on your credit report. Banks see it, the Fed sees it, and so do lenders. But with BNPL services like Affirm, Klarna, or Afterpay, the debt often doesn't appear on traditional credit reports until you default. This creates a massive information gap. The Fed is flying blind. Chair Powell sees healthy bank data and assumes consumers are resilient. But the truth? Millions are already drowning in invisible debt. Second, who's using BNPL? It used to be young people buying gadgets. But this year, the fastest growing category is groceries and household essentials. Did you catch that? Americans are now borrowing to buy food and toilet paper. When a nation's citizens need to split payments over 4 installments just to afford a week's worth of groceries, that's not economic strength. That's a Great Depression level red flag. At least 20-30% of that $13.5 billion came from demand that shouldn't exist, created by fintech companies with lax underwriting standards. This phantom demand will turn into real defaults within 3-6 months. The legalized debt trap. Now let's talk about the visible side of the debt crisis. Credit cards. The average US credit card APR has hit 24.8%, the highest level since records began in 1994. For context, during the 2008 crisis, it was 12-15%. Even in the high inflation 1,980 seconds, it never stayed this high for long. Imagine you charge $5,000 on a card for holiday gifts and only make minimum payments. You could be paying off that debt for 10 years with total interest exceeding double the original amount. But the real danger is delinquency rates. The economy is now on a K-shaped recovery. The top 10% stock and homeowners are thriving, while the bottom 50% wage earners are being strangled by high rates. The New York Fed's latest household debt report shows credit card delinquencies rising fast, especially among subprime borrowers, already surpassing pre pandemic levels. This isn't just numbers, it's the early stages of mass household insolvency, and it's not just credit cards. Auto loans are imploding. With rates above 8-10% and car prices inflated, many borrowers owe more than their vehicles are worth. A slight uptick in unemployment could trigger the largest wave of car repossessions in history. In this environment, the holiday spending frenzy isn't joy, it's desperation. Psychologists call it doom spending. When people feel they'll never afford a home or save for retirement, they splurge before the crash. It's a dangerous mindset, a hallmark of economies sliding from recession to depression. The empty piggy bank, savings are gone. To fuel this $13.5 billion binge, Americans didn't just borrow, they drained their savings. During the pandemic, households built up $2.1 trillion in excess savings from stimulus checks and reduced spending. That cushion kept the economy afloat through multiple rate hikes. But according to the San Francisco Fed, those savings were fully depleted by Q3 2025. Now, the US personal savings rate has plummeted to 2.9%, a critical danger zone. In normal expansions, it's 5-7%. Below 3% usually signals either irrational exuberance or impending crisis. Given today's inflation and debt loads, we're clearly in the latter. Without savings as a buffer, American households are extremely fragile. They're like tightrope walkers on a unicycle. One small shock, a new tariff, a layoff, a medical bill, and they fall. Yet Wall Street still expects strong consumer spending in Q1 2026. That's fantasy. The tank is empty. The car is coasting on fumes and the cliff is just ahead. Why are stocks still up? The Wall Street illusion. If things are so bad, why are markets rising? Why do Walmart, Target, and Amazon still look strong? Because of a time lag and Wall Street's narrative tricks, retailers are sacrificing profits for volume. To clear inventory, they're slashing prices, eating higher shipping and return costs. The $13.5 billion is revenue, not profit. When Q4 earnings come out in February, margins may collapse. This is a sell the noise, buy the silence game. Then there's shrinkflation and quality downgrades. To avoid raising prices too fast, companies reduce package sizes or use cheaper ingredients. This erodes brand trust and kills customer loyalty. And let's not forget expectation management. Analysts lower forecasts so low that even mediocre results look like beats. But watch inventory to sales ratios. Many discretionary goods companies are sitting on bloated stockpiles. If holiday sales were mostly low margin clearance items, Q1 restocking demand will crash, hitting manufacturers and logistics. The market is pricing in a soft landing. Inflation fades, rates drop, consumers keep spending, but the data says otherwise. High inflation, high rates, low savings, high debt. This formula has never led to a soft landing. It leads to crash landings, the 2026 time bomb when the music stops. So why am I so certain the reckoning comes in early 2026? Because economics has one unbreakable rule. You can borrow from the future, but you can't avoid the bill. The real danger isn't just credit card defaults, it's the collapse of the hidden leverage beneath the surface. BNPL's shadow debt will face its first real stress test in Q1 2026. These loans don't fully appear on credit reports, so banks and the Fed see a false picture of financial health. Much of the $13.5 billion came from subprime borrowers, people already rejected by traditional lenders. This is subprime 2. When these consumers face rent hikes, heating bills, and holiday debt in January, many will default en masse. This triggers the first domino, liquidity crunch. BNPL providers will take massive write-downs, their stocks will crash, and regional banks that funded them will tighten credit. Even if the Fed cuts rates, banks will hoard cash, creating a pushing on a string effect. Policy works, but the pipes are clogged. Then comes the corporate profit collapse. Retailers have been using price hikes to protect margins, but that ends in 2026. When consumers hit their price ceiling, even a 1% increase will crater sales. CEOs will start using phrases like inventory pressure, weak demand, margin compression. This won't just hit Nike or Starbucks, it'll spread to advertising. If people stop buying, brands cut ad budgets. That hits Google, Meta, and Amazon's ad revenue. The market believes AI will drive endless growth through efficiency. But if demand collapses, who will see those AI generated ads? This is the biggest valuation risk for trillion-dollar tech stocks, the wealth effect reversal. When the illusion shatters, the most destructive force isn't debt, it's the reversal of the wealth effect. For 2 years, rising stock and home prices created a false sense of wealth. Americans felt rich, so they borrowed and spent. But it was all paper gains. When markets drop 15-20% in early 2026, that illusion shatters. For the middle class, 401 accounts aren't just savings, they're psychological anchors. When those balances plunge, fear spreads faster than any income loss. People stop spending. They start hoarding cash, repairing balance sheets. This triggers a paradox of thrift. Individual prudence causes collective collapse. Consumption spirals down, leading to a balance sheet recession, exactly what Japan suffered in the 1990 seconds. The real gold rush, how to survive and thrive. So, what should you do? First, understand the real opportunity isn't a 10-15% dip. That's not a golden dip, it's catching a falling knife. The true golden moment comes when markets face panic selling, liquidity dries up, and quality assets are dumped alongside junk. That's when cash becomes king. You want to own pricing power, strong cash flow, and businesses that serve essential needs regardless of income level. Think utilities. People always need power and water. Staple consumer goods survival isn't optional. Hard tech with real moats, not hype driven AI plays. These will be discounted to fire sale prices in the chaos. But the real challenge isn't picking stocks, it's mastering your emotions. You must short greed, go long on patience. Wall Street will keep selling the soft landing myth. They profit from trading volume and fees. They won't tell you to leave the party. They'll say every dip is a buying opportunity. But data doesn't lie. The $13.5 billion anomaly, the smart money exiting, insiders selling is the thunder before the storm. This isn't a correction, it's a cycle ending. In this moment, blind optimism is suicide. Stay liquid, stay vigilant, stay patient. Because when the dust settles, the survivors won't be those who chased the last rally. They'll be the ones who held cash, stayed calm, and bought when others were selling in fear. And that's how you turn crisis into generational wealth.